The 2008 financial market crash was so big that it put the whole world into recession.
1.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate on about 18%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
It was the worst day on Wall Street since the crash of 1987.
We've had an 8-day losing streak in the Dow that in percentage terms puts it on par, close to the loss suffered in that crash in 1987, close to that percentage loss those 2 days in 1929.
What started in America last year has now spread to every part of the world.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
This could be the most serious recession in decades. And that means life, as most Americans know it, is about to change, in some cases dramatically.
Everyone was losing jobs and was not even able to feed their families. But there was one person who profited the most from this crash. His name is Michael Burry, a hedge fund manager who managed some funds. How did Michael Burry figure out about the potential crash? Why exactly did the financial crisis happen? We will find out in this video. The two important factors in this financial crash were the American dream and the greediness of the big banks. The American dream we all know is the idea that everyone is hardworking, has a good job, and owns a home. Every immigrant who comes to America has this American dream, and they strive to buy a home by working hard. Now, let's start from the beginning. The most important aspect of the 2008 home crash is that everyone wants to own a home. To buy the home, banks provide loans. When a borrower goes to the bank to get a loan, banks cross-verify whether that person is capable of paying back the loan. If the person is not capable of paying them, banks usually reject the loan. If the person is capable of paying back the loan, then the bank gives him the loan and earns interest. This is how commercial banks make money by giving out loans. But what happens after the loan is given by the bank? Let's say 10 people have taken a loan from ABC Bank to buy a house, and they owe money to ABC Bank. Now, what ABC Bank does is sell these loans to an investment bank. Now people owe the money to the investment bank. The investment bank combines these loans and creates new products known as mortgage-backed securities. This process is known as securitization and allows investment banks to transform a portfolio of individual loans into a tradable security. This product is then sold to investors. Investors trust these mortgage-backed securities because they are considered one of the safest investments, as everyone pays their home loans to own a house. These home loans are the fundamental part of these mortgage-backed securities. In mortgage-backed securities, these loans are rated by rating agencies like Moody's. The rating is done according to the behavior of the borrower. It is called a tranche. For example, if a borrower pays the premium on time and never misses any premium, the probability of such a borrower paying back the loan is higher, so such loans are typically rated higher. These loans are rated as AAA loans. Another type of borrower might miss some of the premium here and there, but at the end he will pay back his loan. He may pay it a little late, but in the end he pays it back, and this type of borrower is slightly riskier than the previous type of borrower. So, such loans are rated a little lower. These loans are rated BBB. And the third type of borrower might default on his payments and not be able to pay back his loan. Such loans are rated lower, and they are rated as CCC loans. Now, when an investor invests in such mortgage-backed securities, they first check the overall ratings given by the credit rating agencies to these mortgage-backed securities. If a mortgage-backed security had a higher number of AAA loans, it was considered a safer investment by investors. But there was another problem because investment banks and credit rating agencies were hand in hand. The credit rating agencies never gave the true rating to these loans. For example, if the loan actually had a rating of CCC, but the credit rating agencies ignored that and gave it a rating of AAA. So all these mortgage-backed securities were rated higher because of these fraud ratings by credit rating agencies. Because of this, investors thought these mortgage-backed securities had the majority of AAA-rated loans, but instead they were all filled with the majority of CCC-rated riskier loans, which made these mortgage-backed securities much riskier than investors thought. This whole process was very beneficial for the banks. Banks would just give out loans, and then they would sell these loans to the investment bank. The investment bank would then just create mortgage-backed securities with these loans, and credit rating agencies would rate them higher. Then it was sold to investors as a safe investment. But all of this was going on the assumption that everyone paid their loans, which, in the majority of cases, is true. But the number of loans a bank can give is limited to people who have a good income. So banks started to give ARM loans, which means adjustable rate mortgages. An adjustable rate mortgage is a type of home loan that has an interest rate that can change periodically over the life of the loan. Before the 2008 financial crisis, lenders and banks were offering ARMs with very low initial rates to entice borrowers, but those interest rates would increase after the initial period, often causing payments to become unaffordable for borrowers. This attracted many borrowers who were not responsible with their finances, ultimately leading to many bad loans. This led to more CCC type of loans in the MBS product. To entice more borrowers, banks started giving interest-only adjustable mortgage (IO) ARM loans. It is a type of mortgage loan that allows borrowers to pay only the interest portion of the mortgage payment for a certain period of time, typically the first few years of the loan. After the interest-only period ends, the borrower must begin making payments that include both principal and interest. This type of loan became popular in the years leading up to the 2008 financial crisis, as it allowed borrowers to make smaller monthly payments during the interest-only period, which could make homeownership more affordable. This attracted even more risky borrowers to take out loans. However, these loans were also associated with higher risk, as borrowers were not paying down any principal during the interest-only period. But when the interest-only payment period was over, they were often unable to pay the higher payments that included both principal and interest. If interest-only, adjustable rate mortgages were not enough, the banks wanted to entice even more people to take loans. So later, the situation got even crazier, and banks started giving an interest-only, negatively amortizing, adjustable rate subprime mortgage (IO NAARM). This was the worst type of loan, in which the borrower could pay almost nothing or a very small amount of the premium every month, and their remaining premium amount would get added to the principal amount of the loan. This type of loan attracted even more risky investors, who just borrowed money and then eventually defaulted. The credit rating agencies gave AAA ratings to such loans, which were added to the mortgage-backed security product. Because of this, mortgage-backed securities were mostly filled with riskier and worthless CCC-rated loans, which was nothing but a ticking time bomb. All of this craziness was going on the assumption that demand for houses would keep increasing and the price of houses would continuously go up. Also, the interest rates were lower when giving out these loans. When interest rates started to go up or were readjusted for the loan amount, many of these borrowers were not able to pay any of these loans, and they started defaulting on their loans. So banks took their homes to resell them. This started to happen with all the loans that were given, and eventually everyone was defaulting on their loan. So this created a huge supply of homes in the market where there are not enough buyers. This resulted in home prices starting to go down and resulted in a wave of foreclosures when home prices declined. But the banks were not even able to get 50% of the original value of the house. Once the borrowers started defaulting, the cascading effect started, and the investors who bought the mortgage-backed securities of these loans also started losing money. So it was a chain reaction that started from the bottom and ended at the top. In the 1980s, the US government passed the Secondary Mortgage Enhancement Act, which allowed pension funds and insurance companies to invest in these private MBS. The pension funds and insurance companies were heavily invested in the MBS, considering they were safe investments because the credit rating agencies gave them good ratings. But these pension funds and insurance companies lost huge amounts of money during the crash, wiping out the pensions of the hard-working common people. Now, all of this chaos was happening while everybody was unaware of what was going on. There was one guy, Michael Burry, who was carefully observing what exactly was happening. As the loans written by the banks had to be reported to the SEC, all this data was in the public domain, and even the big investment banks with big research teams were not able to figure out this ticking time bomb.
Watch, it will pay. I may have been early, but I'm not wrong.
Once people started defaulting on their loans, the domino effect started, resulting in a global recession. When the housing market crashed, Michael Burry received all the premium amounts he paid for those credit default swaps and the value of the contract they fixed.